With the rise of crypto and a spike in interest from retail and institutional investors, it is important to talk about how to invest in crypto because crypto is very risky, especially altcoins. And a lot of crypto projects back then were wiped out and no longer exists today. Cryptocurrency's future outlook is still very much in question. Proponents see limitless potential, while critics see nothing but risk. With great risk equals massive potential and gains. I believe in crypto and think it's the future. Its technology is revolutionary. And you are investing in the future if you are investing in crypto, in my opinion. Even engineers are quitting big tech companies because of a once-in-generation opportunity with crypto. Why stick around and work for Google when you can start your own chain and go on an easy path to becoming a billionaire? Even a subpar chain like Tron have escalated Justin Sun, Tron's founder, to a billionaire status. By the way, Tron has stopped development despite receiving a lot of funding, despite crypto being considered to be in its early stages. A lot of big tech companies in Silicon Valley are already seeing a mass exodus with their engineers' talents flowing into the crypto space. We also saw a lot of venture capital money last year. Venture funding in 2021 broke records across the board, Crunchbase data shows, with investment last year up more than 10x what it was a decade earlier. Global venture capital funding smashed records last year, nearly doubling the previous year's total. In 2020, VCs spent $335 billion per Crunchbase last year. They spent $643 billion. A venture capital fund is a form of private equity raised from private and institutional investors, such as investment banks, insurance companies, or pension funds. A venture capitalist is someone who makes these kinds of investments. One of the spaces getting massive funding is crypto. Some of the companies investing in crypto are MicroStrategy Inc., Tesla Inc., Coinbase Global Inc., Square Inc., PayPal Holdings Inc., Marathon Digital Holdings Inc., Nvidia Corp., etc. Before we begin, please subscribe and turn on the bell icon to receive notifications. Alright, now, let's begin. Some of you might be wondering if I use any of these methods that I discuss or buy the coins or other assets I talk about. The answer is I do. And some of the coins I've either mentioned here or on my Facebook group performed well last year, such as Matic, Gala, Solana, Luna, Cadena, etc. All of those I mentioned are good long-term and even outperformed Ethereum and Bitcoin. I care about coins with utilities. You want to buy coins with good fundamentals, but utility is the most important. Although crypto can be fun and exciting, remember the best investment is yourself. If you have very limited capital, you want to focus on yourself and get more fiat money. Although you can utilize crypto as a savings account with better returns than traditional banks, you can't realistically expect to make millions overnight with limited cash. Always believe in yourself because your potential is limitless. There's only one important person you will meet in your life, and that is you. Mindset is very important, and it can shape us mentally and physically. Before investing in anything, you must assess your risk curve. The risk curve is a two-dimensional graphic that depicts the relationship between the risk and return of one or more assets. Multiple data points representing various specific security or asset classes can be found on the risk curve. It's used to visualize this data for mean variance analysis, which is crucial for evaluating the relative risk and return of different asset classes and categories in portfolios and investment models like the capital asset pricing model and modern portfolio theory. So, the risk curve is a visual depiction of the trade-off between risk and return among investments. Riskier assets with a wide range of historical gains and losses will also tend to a higher average expected return. This is why the gains in crypto are so massive, since it's very risky. In investing, it's important to understand your risk curve. Even in investments that are considered safe have their own risks. This leads us to our next point. You must determine how much risk you would accept. Everyone is different and have different appetites for risks. Generally, a younger person has higher risk tolerance than a person close to retirement age because they have more years to recover. Risk assessment is critical for establishing the value of a particular investment and the optimal process for risk mitigation. Risk assessment is necessary to establish the rate of return required for an investment to be considered worthwhile despite the potential risk. In the crypto space, it is undoubtedly risky. Cryptos are still very experimental. Even the two biggest cryptos, Bitcoin and Ethereum, started as experiments. Crypto is like investing in tech startups. There are a lot of uncertainties and it's experimental. There have been many innovations such as smart NFTs, DAOs, etc. DAOs weren't a thing in the previous bull market. DeFi wasn't a thing until Chainlink. And it's important to understand these things and stay up to date with these trends because understanding these can potentially make you rich. In the financial world, risk management is the process of identification, analysis, and acceptance or mitigation of uncertainty in investment decisions. When it comes to investing, there are no guarantees, only probabilities. Even though there are ways to play the game strategically, it is a numbers game at the end of the day. Successful outcomes are all a numbers game too at the end of the day. But you can do things to better your odds. So, never give up and always improve to better your odds. To mitigate risks, practice good risk management such as dollar cost average, buying with risk capital, diversifying, gradually taking profits, and safeguarding your cryptos. Dollar cost averaging is an investment strategy that aims to reduce the impact of volatility on large purchases of financial asset, where the investor invests the same amount of money in the same asset on a regular basis over time. Don't use credit cards or borrow money to invest. In theory, there is nothing wrong with borrowing a modest amount to buy more assets, but only if you are sure you can ride out the volatility and will get a greater return. Otherwise, you will end up losing and not winning from the trade. Going back to the statement I made earlier that there are no certainties, only probabilities. Using borrowed money is very risky. Risk capital refers to money set aside for speculative purposes and utilized to make high-risk, high-reward ventures. Risk capital refers to any money or assets that are at risk of losing their value. Never invest in the money that you can't afford to lose. For every amount you invest, you have to be comfortable with the fact that you might lose it. You can start small and add more if you are comfortable and feeling confident. Investing is meant for the long term and not for the short term, and long term is usually safer. So, don't invest any money you need in the short term. Risk capital can be made more efficient in terms of the risk-reward trade-off through diversification. Diversification is important in lessening risks. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. For example, you can invest and diversify in different assets such as crypto, real estate, stocks, NFTs, bonds, ETFs, and gold. It's considered safer to diversify in different assets as opposed to having your net worth tied to one asset class. This practice is designed to help reduce the volatility of your portfolio over time. It works and is very effective, but you don't want to over-diversify. Over-diversification happens when each additional investment added to a portfolio decreases the expected return by a higher amount than the risk profile reduction. If you are over-diversifying, you are spreading yourself too thin. If you are spreading yourself too thin, then you might have lower expected returns. Instead, you want to select the projects you know, can manage, and really believe in. In fact, you probably want to have mostly Ethereum and Bitcoin in your portfolio since those two seems to have the most resilience according to a lot of investors. However, this isn't always true when there have been other coins that have better tech resiliency too, and outperform both Ethereum and Bitcoin. It is not required to have both Ethereum and Bitcoin, but it is suitable for beginners. Other blue chips like Matic, Link, VET, and DOT can be suitable investments for beginners too. Even I don't hold any Bitcoin or Ethereum. You don't want to sit on your investments in crypto. Maybe if it's Bitcoin or Ethereum, you can hold it for years. In my opinion, we should take profits at all-time highs. Take 50% for degen and 5 to 15% for blue chips. But you can adjust this percentage depending on how much has been pumped. Remember, getting rich quick and getting poor quick are two sides of the same coin. If it pumps just as much, it can tank just as much too. You can use any crypto tracker or go to CoinGecko to see the all-time highs. For security reasons, you don't want all your crypto sitting in exchanges unless you want to trade them. You might want to store it securely offline. You can use a hardware, software, or paper wallet. In this video, I explained about the different ways to securely store your crypto. You also might want to consider buying another computer where you do your crypto business and have it disconnected from the internet because this will make it harder for hackers. Next, you want to create an investing thesis. An investment thesis is a written document that suggests a new investment based on study and analysis of the investment's profit potential. Individual investors can use this method to research and select investments that will help them achieve their objectives. The investing thesis is a tool used by financial professionals to pitch their ideas. Everyone has different goals and it's important to identify them. Once identified, select investments that meet your goal. Keep in mind your priorities. Priorities can help you reach your goals. After assessing risks and creating an investment thesis, you want to log everything. Write everything you buy down, every trade and every transaction. You especially want to know what price you initially bought the coin for, because this can be an indicator whether or not you are in profit. You can track everything down on an Excel spreadsheet. Alternatively, you can use apps such as Mint. Mint is also a good budgeting app. You can also download logs from the crypto exchange websites too. I recommend using KuCoin, Gate.io, and PancakeSwap. KuCoin is the best because it has so many listings that aren't available in other exchanges, have a lot of features, and low trading fees. KuCoin is also the best place to stake in my opinion. The primary benefit of staking is that you earn more crypto, and interest rates can be very generous. Although you can stake on exchanges, your crypto is locked in a certain period of time. Alternatively, you can also stake on wallets. You want to watch out for high trading fees because those can really eat your money away. Gate.io have lots of listings too and are sometimes exclusive. When it comes out on big exchanges, such as Coinbase and Binance, it pumps a lot. LRC Pump when it got listed on Coinbase as an example. There are some exclusive gems on PancakeSwap too. For KuCoin and Gate, I send XLM from Coinbase Pro and then sell it for USDT for other coins because XLM is very fast and there is no fee sending XLM. Also, the Pro version of Coinbase has significantly lower fees than the regular Coinbase app. So, I transfer fiat money from Coinbase to the Pro version. In addition to trading fees, you trigger a capital gain or loss every time you sell. So, you can use tax harvesting strategy to lessen taxes. I know Coinbase is very big and most beginners use it. It's very easy to use and there's a learn and earn program. But you are losing money in the long run with all the fees. You have to have a strategic plan when investing. But it is also psychological. Both investing and trading are psychological to an extent. A lot of people, especially new investors, feel lost or panic during a market downturn. When the market is up, it can be an indicator that investors are too greedy, and investors are fearful when the market is down. So, the market moves in what investors are feeling. A good tool to measure investors' sentiment is the Fear and Greed Index. You want to buy low and sell high. So, you should buy into people's fear and sell into their greed. It is very normal to see negative 50% due to the volatile nature of crypto. Don't sell or panic, nada, in a market downturn. If you sell, you'll most likely lose. Instead, you should be buying and rebalance your portfolio during a market downturn. If you want to get the best deals, learn the fundamentals of technical analysis. It is a trading discipline that uses price trends and patterns on charts to evaluate investments and locate trading opportunities. Learning how to read charts will be very helpful. It can help identify an entry point, but also exit points too. However, the accuracy is never 100% correct. This leads to another point. Exit strategy. You want to have an exit strategy for every trade. Another indicator of sentiment is the price fluctuation of Bitcoin, the king of all crypto. Crypto investors and traders follow regulatory developments related to Bitcoin closely because it is an indicator of liquidity in crypto markets. Because Bitcoin is so big, other altcoins tend to follow it. However, the more we focus on Bitcoin's daily swings and weekly swings, a lot of our energy gets wasted on that and we miss out on some great opportunities. Many investors were feeling bearish and lost during the last dip. The markets were down due to the Fed's hawkish pivot, rising bond yields, the Fed's move to raise interest rates, and the turmoil in mining powerhouse Kazakhstan. According to many sources, many average investors are mostly wrong. Even well-known ones are wrong too, and no one can time the market perfectly all the time. So, you shouldn't really be listening to anyone and do your own research. Be cautious in the crypto space. There are a lot of scams and you should trust no one but me. JK, just kidding. But seriously, don't trust anyone. Use your best judgment and do your own research. Everyone is biased and people can use Google, the largest search engine, to confirm their own bias. This is because folks, often subconsciously, search for info that confirms current beliefs. Sadly, this short-circuits clear thinking and halts growth in its tracks. So, that's why it's important to search for different views and also look for unbiased facts from credible sources. People always have bias and some people are unaware of it. That's why bias training has to be enforced consistently. People believe just because one thing turned out really well, and that they put all their eggs into that one basket, they'll be set for life because that investment will give them a great return. In reality, this doesn't always work out. This view of past performance is really erroneous or flawed. In data science, past performance doesn't indicate future performance. In other words, past performance doesn't guarantee future returns. Even social media influencers can be biased or show coins just to dump on you. To be frank, many people don't do their research, and as a result they'll likely not go very far or even fail in crypto. And then they'll probably go complain and say crypto is a scam or look for advice from online strangers that seem smart. Social media influencers are like businesses. They are mostly concerned about being profitable. Sometimes they are endorsed or paid to talk about a product or service. Even data can be skewed and biased too. Social media influencers leverage tech to make money. And you want to leverage tech to your advantage too. Use Twitter, Reddit, Discord, YouTube, or Facebook to follow these crypto projects, communities, founders, and stay up to date to trends. YouTubers also talk about what people want to hear. For example, Crow was very hyped when Crypto.com bought the naming rights. Many YouTubers were saying Crow will reach over $1, but I knew it won't because there was too much selling pressure. The thing with hypes is that you want to get in early but shouldn't be chasing. Keep in mind hypes can lead to bubbles. You want to get in early to make the most gains in crypto. One of the best ways is to follow launchpads. Look into their website for more information about them. Read their white papers. White papers explain the purpose and technology behind a project and is issued by the company. They usually provide statistics, diagrams, and facts to convince interested investors to purchase the cryptocurrency. The white paper should also explain the business problem you are tackling from the perspective of the potential users of your blockchain product and address how you plan to solve the problem or address the opportunity. Another thing to look at is their tokenomics. Tokenomics is the study of the economics of crypto tokens or cryptocurrencies. It's a combination between token and economics. It entails examining the factors that influence the demand for and supply of tokens. Quality, distribution, and creation of crypto tokens are all issues to consider. It is usually in its white paper. Speaking about tokenomics, you want to learn about economics. Even learning about the fundamentals of economics is important when determining value and where the cash is flowing. Additionally, economics helps us understand the world around us and how it really works. It also helps us to understand people, governments, businesses, and markets and why they make the economic choices they do. Additionally, it can teach perfect and imperfect competition, taxation, international trade, price controls, monetary policy, exchange rates, interest rates, unemployment, and inflation, among many other things. Let's now talk about another crucial subject, game theory. No, not yes theory, game theory. Although game theory is a yes theory if you know what I mean. The study of mathematical models of strategic interactions among rational beings is known as game theory. In a strategic environment, game theory is a technique for formulating alternative strategies to compete with one another. And it is also an important tool for making decisions based on changes in key topics. In crypto, it moves fast. There are always innovations or improvements. You, as an investor, must move quickly and make sound decisions. That's why it's important to learn game theory. I have more tips, but this video is getting too long. For the ones that made it to the end, thank you. Here are some bonus tips for sticking till the end. Look up Steemit, yield farming, airdrops, earn free BAT tokens through your Brave browser. And it's very imperative to learn about blockchain technology. What other tips do you have? Or how has your journey in crypto been so far? As always, this was James and I'm logging off now. Stay safe, awesome, and all the best for the new year.